Let's talk first about mutual funds and ETFs and just how they work when it comes to taxes. Okay, because if you understand how mutual funds and ETFs work, it naturally goes into index funds because index funds are held almost all the time via mutual funds or ETFs. So, just as with any individual securities like stocks, bonds, whatever you may purchase, when you sell shares of a mutual fund or ETF, that's an exchange traded fund for those of you guys who may be new or don't know. So, if you sell shares of a mutual fund or an ETF for a profit, you'll owe taxes on that, what we call a realized gain. Because you can make gains on whatever it is. The price of any individual stock or an ETF or a mutual fund or whatever can go up, 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 up. And as long as you don't sell and what we call realize that gain, then those are called unrealized gains, and there are no tax implications to unrealized gains. But let's say you do sell, you realize a profit, and you have that realized gain. Quite clearly, we'll owe taxes on that gain if it's held within the traditional brokerage account, right? But you may also owe taxes if the fund realizes a gain by selling a security for more than the original purchase price, even if you haven't sold any shares. So what's this mean? This means if you have a mutual fund or an ETF that holds individual stocks within it or individual bonds or individual securities within it, and they sell those individual securities for some gain, then what will end up happening is the fund will pass those gains on to the investors of the fund, therefore increasing your taxable income, increasing your tax bill based on the fact that they made those sales. Now, not just your taxable income because something may be sold at a longer term capital gain, but nonetheless it will increase your tax bill. Okay, so what happens when the fund passes on the gains? This could lead to several scenarios that might surprise you. In a down market, shareholders often take money out of funds, meaning the fund manager has to sell some of the fund's holdings to meet demand. If the fund sells lots with large built-in gains, this could lead to net gains, which you'll be taxed on, even if your fund's share price went down during the year. So this is a big bummer that occurs within any type of mutual fund or ETF when the market's going down and everybody sell, sell, sell. Well, the fund manager is having to come up with the money to meet all of the demand for the selling. Well, in doing so, he or she may be selling whatever is in the fund, whatever individual securities they own within the fund. Well, in doing that, what they may be doing is locking in gains, realizing gains that you are going to have to pay taxes on, even if the price of the mutual fund or ETF has gone down. So that could be a particular issue. Also, you might buy shares of a fund that realizes capital gains soon after you purchase, in which you'll owe taxes on these gains, even if you haven't been invested long enough to benefit from those particular gains. So again, there can be selling that goes on within the fund shortly after you purchase, right? Because there is no statute of limitations on ownership to where you don't realize gains until after that point. No. You are still going to have to realize those gains even if you haven't been invested that long, which is a potential bummer, right? But on the flip side, capital gains are considered to be short-term or long-term based on how long the fund held the securities being sold. So even if you have held something over the short term, right? And the fund held something for more than a year. The fund held something over the long term and they realize a gain for whatever security that may be, then you will still realize a long-term capital gain, not a short-term capital gain, which can be beneficial. Okay, so the bottom line is if taxes are a concern, it's a good idea to look into a fund's unrealized capital gains before investing a large amount and find out whether a capital gain distribution is imminent. Okay, you may also want to consider investing in index funds, which is what we are talking about today, because those do have specific tax advantages to them that the actively managed mutual funds or ETFs may not have. Okay, but you need to understand that when you go about buying funds, there are tax implications, and they are not all reliant on you. They're not all reliant on the buying and selling that you do. They are reliant not only on the buying and selling that you do, but also on the buying and selling of the particular fund manager that you choose. So you could see where having a lot of turnover within a particular fund could be a disadvantage to owning any type of fund. And you can also see why that eats away at net returns in the way that Jack Bogle talked about when we talked about that on Monday. We talked about things that Jack Bogle said and the reasons that active managers underperform, because if they are doing a lot of trading, they are having a lot of realized gains come through at any given time, especially in the short term, then that will reflect in your returns, which is what we do not want. We do not want taxes eating away at our net returns, and that's exactly why we talk about this today, because we are trying to be as tax efficient as possible and minimize our tax burden when it comes to our investing life.